Hi guys, my name is Frank Chaparro, senior correspondent at The Block. You might know me as Frankie Scoops or FinTech Frank, but hopefully now you'll get to know me as the host of The Block's new podcast called The Scoop, made especially for decision makers and thrill seekers in the crypto market. Each week, I, along with one of my cohorts here at The Block, will talk with CEOs, innovators, and builders across the crypto market. Michael Moro is probably one of the most veteran crypto traders out there. In this episode, Ryan Todd and I welcome Moro, the CEO of trading firm Genesis Global Trading, to explore how the firm gatecrashed crypto way back in 2013. Then Moro says folks would show up with briefcases full of cash to make an over-the-counter trade. We also talked about where the firm is going next. Last year, it opened up a lending desk which has originated over $1.5 billion in crypto-backed loans. And now, Moro says, the firm is looking to expand its suite of offerings, building what could become one of the first crypto full-scale prime brokers. We finished with a conversation on how he expects shifts in the market to impact the business and where he sees the potential for pockets of risk to form within crypto lending. I'd like to take a minute to thank our sponsor, Cash App. Cash App has been the #1 finance app in the App Store for almost 2 years. It was also the first major peer-to-peer payments app to start supporting Bitcoin, and it's still the fastest and easiest way to on-ramp fiat. No more waiting 5 days for your ACH payments to come through. With Cash App, you can buy Bitcoin instantly. It's also a favorite of the Block analyst Steven Zhang. He uses Cash App when he goes to Chipotle and gets money back he saves every time he eats a burrito. That keeps Steven happy, that keeps the Block happy, and that keeps the crypto world informed with the best news and research in the entire market. You can also use it at Lyft, Whole Foods, Chipotle, as I said, Chick-fil-A, Starbucks, and Dunkin' Donuts. Download Cash App today from the App Store or Google Play. I hope you enjoy the episode. Thanks for tuning in, everyone. This is The Scoop. You could have been listening to the 1,000 other crypto podcasts that are out there, but you've chose us, and we appreciate it. And we have a great, very special guest today, Michael Moro, the CEO of Genesis Global Trading. And of course, I'm joined by my colleague and good dear friend, Ryan Todd. And we're going to be diving into some very interesting things. Michael has been a long-time friend, source, consigliere in the crypto world to me. When I first met him, I didn't know the difference between a piece of biscotti and a Bitcoin. And he's been incredibly influential in the entire space on all things OTC, trading, exchanges. I mean, you name it, Michael is your guy to unpack and unearth some of the most pedantic, wonky, and frankly, from my perspective, interesting topics in the space. Michael, thanks so much for joining us today.
Thanks for having me. Glad to be here.
Yeah, no, it's a great pleasure to have you. Let's talk a little bit for our guests about Genesis. It's a name that a lot of folks might not know in crypto trading. You know, millions of dollars worth of crypto, probably a month, multi-millions of dollars worth of crypto every month, facilitating over-the-counter trades. What's the origins story behind the firm? I mean, it dates back to Second Market, which was in equities and kind of found its way to crypto. Let's sort of walk through that.
All right. Well, we'll go way back. So
it's like 2015, I think.
This is earlier.
This is 2013?
2013 is when we started trading Bitcoin. But the true origin really kind of goes back to Barry Silbert. And when he himself discovered Bitcoin, this would have been in 20...
That's the CEO of DCG.
Yes, the CEO of our parent company, Digital Currency Group, who discovered Bitcoin himself, I believe, in around 2011. And he I think he's probably spent 6 months going from skeptic to interested to convert to full-blown evangelist. And then all throughout 2012, he wouldn't stop talking about Bitcoin in the office. At the time, Second Market was really focused on, it was a broker-dealer, focused on trading off-the-run, illiquid financial assets, things that didn't trade on an exchange, hard to value assets, which obviously sort of became very prevalent after the financial crisis, where certain things that used to be worth $1 were no longer worth $1. And a secondary market was needed to help price things and to potentially transact. And so when he approached us and started talking about Bitcoin in 2012, we didn't understand it. We didn't know what it was. A lot of the education 101 material that is available on the web today, not there. Frank Chaparro, not in the space. And so you try to figure out.
I was very young back then. I was probably like at my high school prom.
That ages me quite a bit now. But for us, we just had to learn what Bitcoin was firsthand. And what Barry did was, so Second Market had, call it 100 employees at the time. And he went out and bought a bunch of Bitcoin and gave every employee 2 Bitcoins. And he said, okay, I'm going to give you guys 2 Bitcoins. I want you to go and find a website that lets you create a Bitcoin wallet. Create your Bitcoin wallet, figure out how to store your private key and everything, and then send me your public address. And I will send you 2 Bitcoins to your public address. And said, okay. Once we did that, he said, okay, you got your 2 Bitcoins. Spend 1 and save 1. So keep 1 for your future investment and find out somewhere to spend the other 1.
Gotcha.
So all of us are Googling places to spend Bitcoin in like early 2013, right? And really like there wasn't a huge range of places we can buy. You know, it was like alpaca socks. And
was Overstock in the game yet?
Overstock, I don't believe they were. So it was really, really limited. So all of us ended up spending our 1 Bitcoin, which was worth like $80, $90 kind of at the time, at like the same 4 or 5 different retailers. But that was really our first foray into figuring out how to hold, how to spend, and private keys, don't lose it. That basic 101 type of stuff we learned firsthand ourselves by doing it. And then we're like, oh, this is just another financial asset, just as illiquid as most other things. Why don't we start trading this stuff? And that's how the trading desk was born.
But so then back then, I'd imagine, you know, Bitcoin obviously has this reputation for being tied to nefarious actors, you know, Silk Road and drug markets. Who were your counterparties back then? I mean, right now, I know a lot of them are other large trading firms. How, you know, as a regulated firm, a broker dealer, how did you go about engaging with some of the firms that would probably want to be on the other side of the trade back in 2013?
It's a very good question. And it was certainly an eye-opening experience for us who were only used to dealing with institutions, whether it be trading stocks or bonds or hedge fund interests and bankruptcy claims and all of the other assets Second Market was trading at the time. Well, Barry literally just gave us his Rolodex and said, here's every contact that I've made in this space since 2011, smile and dial. Start grassroots calling and saying, hey, we're interested in making a market. Let me know if you want to buy. Let me know if you want to sell, to try to like drum up sort of the counterparties on either side. Now, a lot of the counterparties, to your point, were sort of the early crypto anarchists, the people who sneered at things like AML, KYC, onboarding, and many of them would just hang up. Hey, what are you going to do with my information? Why do you need my driver's license? All of that kind of basic stuff. And so that was certainly a new experience for us. For on the institutional side, onboarding and providing documentation, yes, that's a normal course of business, and it just was foreign to a lot of these guys. And so for us, it was pretty scary. We used to have people literally walk into our office with suitcases full of cash and say, I want to buy some Bitcoin. I'm not telling you who I am. I'm providing nothing, but here's my proof of funds, and then open up their briefcase.
What was the largest amount?
I mean, there would be guys that wanted to buy $1 million, $2 million kind of worth of Bitcoin, but providing absolutely nothing. And then comes the explanation, no, sir, I'm sorry, we aren't able to help you. The exit is right this way. But we had more than one of those kind of instances kind of early on, which we knew that we're like, this is not fixed income. This isn't equities. There's something a little bit different about this world, which was clearly.
But it's come a long way. Like since then, it's been, it looks a lot
more commodities
different
than equities, I would say, too.
Yeah, I think that's probably right. And yes, it is dramatically different. I think in 2013, if you remember, was also the year when Bitcoin kind of went from like $80 to like $1,200, $1,300, Mt. Gox, just before Mt. Gox imploded. That was early 2014 kind of when it happened. And it just like the magnitude and the speed of the moves were just like, what is this thing that we're starting to kind of trade? And then when Mt. Gox happened, I think we really thought that Bitcoin was going back to like $100, kind of where it was pre all of that stuff. And if you had told me in 2014, 2015 that like the CME was going to have a Bitcoin futures product out in a couple I wouldn't have believed you. We were so far from where we thought like the CMEs of the world would need to be in this asset class to get there.
It might have been the case that we moved a little too far, or rather a little too quickly, going into 2017 with the rollout of futures. And now here we are with almost every day there's a new announcement that there's going to be another future product rollout tied to this market, or another exchange launch.
Some getting pulled.
Yeah, and some getting pulled. Yeah.
Which to me is amazing. I would have thought that an old like Chicago institution like the CME would have eventually entered as opposed to leading the pack, which typically isn't the mindset, right, of established financial institutions. It's they let startups kind of go out and kind of do their thing, and then they figure it out and they kind of take over. But the CME decided to take a leadership role in kind of doing it. And so were they potentially early? Sure. But I think they basically now have 100% market share in sort of the traditional futures market. And so I'm sure they're reaping the spoils now.
And just thinking about across the trading landscape, now you guys are not alone in this world. You have Jump, you have Jane Street, you have all the Chicago prop shops in this market, making markets and over-the-counter trading. If you think about what it looks like today, how are you differentiated outside of your experience for being in this market for so long? And how are folks and firms in OTC maintaining their competitiveness in this sort of, market that's a little, we've drawn down 60%.
Let me take off my Genesis hat for a second and just try to take a 30,000 foot view on the crypto OTC space generally. Spreads were pretty wide in 2016. I think the 2017 bull market certainly opened the eyes of a lot of the prop traders and kind of a lot of the Chicago firms that you mentioned into entering the space. And I think just the level of liquidity and the sophistication of the participants have certainly helped to bring down spreads. Better execution across the board, much better experience for buyers and sellers, which naturally happens in any marketplace where there is money to potentially be made, right? And so on the whole, 2017, I think, was the huge catalyst for a lot of people. 2018, you would think that in a market in which 80%, 90% price drawdown would cause people to disappear and potentially for spreads to come back and normalize a little bit. It didn't happen. The exact opposite happened. We saw more entrants into the space. We saw more exchanges even open up OTC desks,
crowded.
Right? Even on an agency basis. And so, even in a bear market, we started to see more competition, more entrants, more liquidity providers. And so I'm not sure I'm not sure. I actually believe that spreads are not going to go back to where it was. That spreads are only going to go one way. And that's just closer and closer to the spot market over time. What does that mean?
It's bad news for you guys. It's bad news for all the OTC guys.
On one sense, yes. On the other hand, you're always banking on the idea that you'll just do more trades. So volume should be higher to kind of compensate for tighter spreads. And that helps overall liquidity, volumes, market is bigger. And so we're just taking our piece of a much bigger pie, even though each trade might yield less in terms of percentage on the P&L side. I think different firms react differently to kind of the changing landscape when the jumps of the world kind of enter the space. I think firms that are much more electronic and technology kind of oriented, they try to compete. They try to kind of staff up on their tech side, build a smart order router that is just that much more efficient and can route through different fiat currencies and crazy pairs to kind of arrive at the best price in a bid to try to like squeeze out just a little bit more than everyone else. And there's also an idea to, hey, let's just do trades. Even if the spreads aren't there and it's not justifying the risk of the trade, spreads are coming down, but volatility isn't exactly decreasing.
And some firms are even offering products, different types of swaps and derivatives.
And so you either compensate via tech and try to say, hey, I'm just as good as Jump or Jane Street or whomever, or you go the other way and say, okay, what else can we do? What other additional services or products can we provide? So, which is kind of where the CFDs and the non-deliverable forwards and some of the other products that I think
that's kind of the route that you guys have taken. I mean, when you think about electronification, that's not necessarily where you guys have headed.
That hasn't, and frankly, even in 2019, most of our trading is still OTC. So we don't face the exchanges very much at all. But I think that the firms that have built in the connectivity to 20, 30, 40 different exchanges, frankly, certainly have a lot more access to that exchange liquidity. Given our regulatory position with sort of the broker-dealer and the bit license and whatnot, our thresholds as to which exchanges we can comfortably work with.
Yeah. I remember when we talked about this when we first, not before you got this shiny new office here in Midtown. And we spoke about how you guys wouldn't put more than $5 million on exchange because it's just too risky. Are we still, I think that conversation was probably at the end of maybe early 2018. Are we still in that spot in terms of the exchange market structure being so fragile?
I would say it's pretty barbelled in the way we look at exchange risk. I think the guys that have been around for a few years and the guys that have kind of proper licensing regulation of themselves, we work with, we trust, we'll leave capital there. That's fine. But I think there's also a long tail of exchanges which we just are less comfortable. And not only are we less comfortable, it'll be the exchanges that our regulators would have questions about. Why are you parking assets at that exchange or that exchange? And if we have a difficult time explaining why we're comfortable, that tends to kind of raise red flags with our regulators, right? And so we oftentimes find up putting our regulators hat on ourselves.
Do they ever call and are like, what are you doing on the shitcoin exchange?
We get audited every 2 years by the SEC and FINRA, both come knocking on our door. And AML, KYC is kind of the one big thing that they'll kind of look through from our counterparty files. And yes, they have questions as to who we're trading and why we're trading. And I need to be able to give good answers.
100%. I think it might be interesting just to focus more precisely on what Genesis is up to right now. Obviously, a year ago, I think, you launched this very impressive lending business. At the time, from my perspective, I thought it would feed into OTC, and it almost seems at this point that that's become not the focal point, but certainly can stand alone on its own merit in terms of it being a strong business. Can you talk about the success of that over the past year?
So in 2014, actually, right after we started trading Bitcoin, we had on our balance sheet just a bunch of Bitcoin that we considered to be hold to maturity. Like, we're not selling this thing. This is our principal position. And so we were sitting on a bunch of Bitcoin. And we have friends and family firms in the crypto space that would come to us from time to time and say, hey, can I borrow 50 Bitcoins? Can I borrow 100 Bitcoins? And so it was, and sure, we were long, a bunch of Bitcoins and said, sure, we'll make the loan to you. And it was a much more sort of a cottage business kind of back then. And it really remained that way for years. In 2017, I had a conversation with Barry. I had been talking to him about wanting to create a lending business for some time as a standalone entity. And Barry said, all right, let's give it a shot. And so it was probably mid 2017 when we started to kind of put together the business plan and try to figure out what it would potentially take to launch this thing. And we were ready for launch in March of last year. I wish I could tell you that like I was some price savant that expected the 80%, 90% price decline. So a lending business might do really well. No, it just the calendar just happened to line up that we were ready right after XRP hit $3 or whatever it was in early 2018. And I think the idea for the lending business, we call Genesis Capital, was it's not a bad thing to short. That this idea that like you short something, you're a hater. Or you don't believe in the asset class, or you don't believe in and fundamental guys oftentimes and crypto does not lack passion for people who believe in their coins of choice.
Passion, psychosis.
And the idea of how could you let somebody short? That's anti-moon, right? And this idea of kind of getting the marketplace comfortable with the idea that like the idea of going long or going short exists in every other market. Right. And as a cryptocurrency becomes more of a mainstream asset class, we need to still come up with the same products and services that investors get in every other asset class. They'll come to expect it in crypto. And that a borrow market provides healthy two-way price discovery. And it allows, obviously, people to go long and go short. And you have the ability to turn Bitcoin into a productive asset. For the first time, you can now lend Bitcoin and actually end up with more Bitcoin because you'll get more Bitcoin in-kind interest in return. And then at the same time, the market was starting to mature to the point where people who wanted to be short entered the space. Lending in 2013 would not have worked. Shorting is a technique that like a lot of professional institutional money managers use. We didn't have those back then. And I think the 2017 bull market, in addition to the flood of market makers, a lot more institutional money came in, whether it be the standalone crypto funds or traditional money managers that happened to add a crypto product or whatnot. And they were buying, going long, going short and everything else. And so we had our customer to who would utilize it for shorting. And so 2018, we said, all right, doors are open, come borrow. And as you might imagine, a lot of our first cases were speculators who were borrowing to short. Now, my guess is most of them, if not all of them, were still net long. Right. They still had some net long exposure, but they didn't want to sell it for whatever reason. They'll short it as a hedge. Maybe they were long a futures product and short the spot and to hedge or to arb out some exposure. And then the business kind of took off from there. I'm sure the bear market acted as a tailwind, but the tremendous kind of growth and interest, has taken us to where we are.
But even with the bear market, when you just look at, I mean, thankfully, we know you guys are the 800-pound gorilla because you guys publish what's going on in your book, its volumes, all that type of stuff. And you see these numbers, they're quite eye-watering. I mean, $1.5 billion worth of originations.
Is that from this most recent?
Cumulative, I believe.
Cumulative, but from the most recent report.
Right,
yes.
Right. 40% outstanding loan growth since 3Q. You have about 180 million loans outstanding. When you see these numbers and the market's, considering the market sentiment starting to shift, but the growth is still there, is there, what's driving that that use case still relative to other options in the market that's starting to spring up?
So I have a hypothesis, and it's kind of one I've held during the 2018 bear market. It was like, look, our lending business is doing great in a bear market. What happens in a bull market? What do the speculators, the short guys, they go away, and maybe the pie is bigger, but what happens to our loan book? Do we lose our customer base? And so we were looking at use cases. Why are people taking out borrows? And interestingly, there's a split between people who borrow Bitcoin and people who borrow alts. Bitcoin is predominantly used either for working capital purposes and or arbitrage, market making purposes. There's almost no speculative on the downside, no people who are thinking the Bitcoin price is going to go to zero. On the other hand, if Ether, Litecoin, XRP, some of those alts, you will see people who will speculate from time to time who think that they're overvalued, mostly because they're overvalued relative to Bitcoin. And whenever you see a price pop, you'll see that the kind of net scenario sort of play out. So I think that in the bull market, while the speculators may certainly go away, and hopefully they do because they don't get run over on the short squeeze scenario, I think the pie regarding working capital lending gets bigger. I think there'll be a lot more market makers, which will need borrow to help settle and do the float transactions. That'll be bigger. And it's actually played itself out. So I'll give you an update even on this new report. So as of March 31, we had 181 million, right? And then but the cutoff date was March 31. What happened first week of April? We had Bitcoin price run, crypto price run. And so we were seeing kind of real time, like what happens to our loan book. So the Bitcoin shorts, the little that we had, closed out. And some of the alt guys close out. And then in the price run. But then what we saw was more working capital loans come out. And then we saw shorts in alts. And so shorting interest in that took off. So here we are on April 23rd. Sound about right?
Sounds good to me.
Our loan book is just about $250 million. Wow. So we're at 250 million, up from that 181 that we just had just a few weeks ago. And so the hypothesis around, hey, is it just for shorting? It's turned out to not be the case.
Yeah.
It's not reality, and that the loan book and businesses like ours should continue to perform well, even in a rising price environment.
Mm-hmm. Something else to call out from that recent lending snapshot, the report mentions market makers and high frequency trading firms coming in. What's the profile in these types of shops? Is it more crypto native, or is it your more traditional legacy Chicago type operation, or a blend of both?
It is a combination of both. I think the market makers, for the most part, are just pure crypto guys.
Got it.
The ARB guys, they will find price inefficiencies in any market that you can possibly find. So you'll see the more the Chicago guys kind of playing some of that, and they'll buy the future, short the spot, that kind of stuff, where they still need access to the spot borrow to be able to execute their strategy.
Thinking about the trading side of the business, and we kind of hinted at it earlier in the conversation about how many firms are going electronic. They're launching their own GUIs to engage with counterparties electronically. DRW's Cumberland, that UK shop B2C2 has done something similar. Why doesn't your firm feel the need to go that route, and how much opportunity is there for you guys to stay traditional OTC as it's been, and also not get into new products and new derivatives?
I think that for us, our real focus has always been what's missing. What's missing from the landscape of market infrastructure that institutional investors are going to come and expect. And clearly in 2013, there was no OTC trading desk. And then when we launched our lending business, there really wasn't anyone doing what we were doing. And so our heads are much more around the next service, the next product, as opposed to, hey, let's compete on the technology side with somebody who's been doing this for decades and decades with, a lot more experience, headcount.
What makes a firm, I think we've talked about this before in the past. What makes a counterparty or a firm, hedge fund probably, more interested in trading with Genesis in that traditional sort of over Skype, wire the money way than electronically? What is the profile of those types of firms, and what makes it more advantageous to do that?
It's funny. This is a little bit of a carryover from our old second market days. The counterparties that we deal with, certainly they're sophisticated. Certainly they have a technology bent to them, but they still need to talk to people. They still feel very comfortable picking up the phone and say, hey, I want to buy 5 million. I want to buy 10 million. And while the orders will get routed and we'll put it into the platform electronically, there's still tremendous value to kind of having that familiar voice on the other end of the line when you're moving 7 figures, 8 figures at a time. And so for us, where we've been really, really good at is sort of that client relationship, the service level, the experience, and dealing with a regulated broker-dealer. And that's kind of the missing piece is, am I dealing with, do I have any AML KYC concerns about where these Bitcoins came from? Or, are they properly regulated in it? Now, it becomes a much bigger issue the larger the fund you're dealing with, because that's a larger compliance team, accounting team, legal, that do a tremendous amount of due diligence on the counterparties before they're able to kind of trade with you. And so for a lot of them, we're seen as an extension of them as an execution partner, as opposed to a prop trading firm that is trying to scalp you. And so it's much more of a relationship dynamic between us and our counterparties, as opposed to say, hey, these guys are really smart that I'm talking to. They're trying to not give me the best price so that they can make the most money. It's much more about how do we have that conversation and that relationship dynamic.
Think about how you house all these separate businesses pretty coherently, at least from our angle. Is there an advantage to having a lending business, an OTC desk, a DCG, all kind of working together?
So there's clearly synergies between the trading and the lending side of the business.
Right.
Although to Frank's point earlier, the lending business is a business that stands on its own. It does not need the trading business and vice versa. Trading business has clients that lending does not, and lending has clients that trading does not. But they are very complementary. To your point, sort of being part of the DCG umbrella, DCG now has 145 different companies in the portfolio. Many of them are trading clients, many of them are lending clients, and many of them are both. And so there is sort of that DCG network that we certainly tap when we look to expand our relationships and things like that. And obviously knowing the founders and CEOs really, really well, because they're a DCG portfolio company, certainly helps make it easier on the not just on the client prospecting side, but on the due diligence side as well. Knowing that DCG is an equity investor certainly gives us some comfort level on the credit that we would extend on many of these relationships.
That's interesting.
Yeah.
Makes a lot of sense. You mentioned that you guys try to, or at least think of your differentiated factor being looking at where the new market's going to be. A year and a half ago, it was lending. Well, what is it now? 6 years ago, it was actually trading crypto itself. What's the next market you're looking to gate crash, and how are you going to do it?
I think that there's a lot of initiatives underway at Genesis. Unfortunately, I'm unable to talk about most of them.
Let's zero in on those ones that you can.
I would say that I think the world, given the competitive nature of sort of OTC markets in general, the reason why we started doing prop trading in 2013 was because of the illiquidity of the marketplace. There was zero chance that I would have a buyer of $1 million worth of Bitcoin and a seller of $1 million worth of Bitcoin within the same hour back then. It would have been one trade every few hours. And we couldn't be like, let me call you back and then call somebody 2 hours later. That just was an inefficient way to get anything done, which forced Genesis, our second market at the time, to have some inventory. Like we had to have some on hand to be able to do transactions right then and there when the client called in. Over time, liquidity has certainly improved to the point where I don't really think you need to take a massive position at any kind of given time just to have inventory to trade. I think liquidity will continue to improve to that actually lessens the risk profile of the over-the-counter market making business. If you don't have to carry large amounts of inventory and kind of be susceptible to the price swings that may happen. And so in this world, I think the trading business certainly transforms. We're much more of we're not quite agency traders, but I think directionally, I think that's where a lot of the market, the OTC guys will end up kind of going in a world in which you're lucky to make 1 basis point here, right, 2 basis points there. Like, what's the point in taking risk, right?
Yeah.
And then I think furthers a narrative around Genesis being an extension of the client to try to bring about best execution, whatever that might mean.
So going in the way of some of these multi-dealer platforms.
It could be, and marrying that obviously with our lending business,
right? And
having the broker dealer license, having our bit license, having our lending business that is growing significantly. We'll add hopefully. Got 3 or 4 different things in my head that'll some of it will take time, but I think that we'll end up at a place where what Genesis will look like will be a lot more close to what Wall Street institutions, the biggest hedge funds, are more used to seeing.
What they're used to working with, like a traditional prime broker, maybe you'll look like an Instinet or something.
I think that. Directionally, I think that's correct.
That's interesting.
Right. Frank, you mentioned differentiation. Let's talk about competition, at least from the lending side.
It's heating up. I mean, you guys were really the first, and then now you see it on the decentralized
and non-custodials.
Oh yeah, yeah, decentralized and DeFi's catching up to you. What's
He's shaking his head.
I just started getting. We've all got bit by the DeFi bug over at the block.
I'm not convinced, at least from an institutional standpoint. I mean, it doesn't offer KYC, AML properties, which is a no-go for my
Do you even see that as a threat in terms of some of these decentralized lending platforms?
It's much more of a science experiment for me, more than I'm fascinated by it and how it turns out. My view on like decentralized exchanges and some of this stuff, and this comes from conversations with some institutional accounts. It's a little bit, it sounds bad when I put it this way, but institutions need to have somebody to sue. They need to be able to point legally to a contract and say, hey, you were supposed to do something and you breached the contract. This idea, it's decentralized, and so no one is responsible.
We are our own fiduciaries.
Right?
That's what
either no one or everybody is responsible.
Yeah.
Just doesn't work in sort of corporate America. And so in that context of you have a legal contract and relationship between a buyer and a seller or a lender and borrower, and if something goes wrong and you have to take them to court, you need to kind of have that legal venue to be able to point your finger and say you were liable for this, that, and the other. And in the absence of the ability to point to any one person company, it almost falls apart. Like the whole thing is like, because these guys fear the worst case scenario and kind of build up from there. If the worst case scenario is we can't do anything because nothing is standing behind this, it tends to not work. But as I said, I'm fascinated by how this whole thing works, and I think it could potentially work at the retail level. And frankly, 80-90% of crypto is still retail, right? That's a big enough market for folks to kind of disrupt. So I'm watching from the sidelines with more like keen interest more than anything else.
It's a fair point.
To your point about platforms, the other platforms that exist that are sort of more of the custodial, centralized model, I think that certainly many of them or most of them play in a different market than we do. They onboard retail clients and they'll take a little bit here, a little bit there, and sort of try to aggregate Bitcoins or whatnot and make a big loan to an institution. We certainly work with them on certain instances if they have a well-priced loan available for sale, for borrow. We will work with them. And so we're much more partners in a lot of different ways than like direct competitors. And frankly, that's no different than the OTC side. I mean, DRW, Circle, we've traded each other for years and years and years. And
they're some of your biggest counterparts.
Oh yeah, and I actually think that in many ways it would hurt us if they went away. There's not that many counterparties you feel comfortable trusting a $5 million trade with to settle properly. And so years of working together in that trust in a trustless blockchain is still incredibly important in the world of business, right?
What do you think over the past 7 years that you've been doing this, the toughest trade has been, or the worst trade?
Oh gosh, it is when you have a very good client, somebody who's bought, call it 50, 100, $200 million worth of Bitcoin, who suddenly comes to you and wants to buy $5 million of Bitcoin gold. Right? It is illiquid, all a volatile, thinly traded asset. But it is one of your best clients. And you have to try to do your best to make a fair market that wouldn't offend the client. Right? Because in reality, you're just like, I don't even know where to price this thing. Right? But like, you also don't want to offend the client with the way.
Can you even ask why?
Why the frick do you want to buy this thing?
I'm not the guy that was on the phone, but it's most of the time it's okay, here's the price, right? It should be no different than any other trade that you do. But trying to fill that without quoting some crazy spread. Less about Genesis making money, but it's more about Genesis not losing money in that scenario, because your ability to hedge Bitcoin gold at a $5 million clip is a challenge. But that would be an example
I want to know
of
these
difficult
people trying to buy
trade.
$5 million worth of Bitcoin.
That size.
Yeah, that's insane.
That would be, this was not this year, as you might imagine.
Gotcha.
But
during the crazy times,
when Bitcoin gold was $400, right? Like
the halcyon days of this market.
That kind of happened. But back to your earlier point about other competition.
Right.
What I think happens is that as you've seen spreads come down on the OTC side, rates are going to come lower and tighter on the lending side.
Of course. Yeah.
That's already starting to happen. It's more competition. And I'm not, that's just a natural progression of the market. And again, I don't think it's a bad thing for the overall space. What I do think it happens, and I'm a little wary.
Yeah, there's only so many levers you can pull. Are you worried?
Is that loans become mispriced.
Right.
Is that risk gets mispriced relative to the counterparty credit. And it'll be the mini version of like the subprime crisis happening at a much, much bigger, at a faster pace, because these companies are smaller and so they can make decisions faster. And so you'll see sometimes firms that'll like offer high rates, like introductory rates, just to buy customers, right? And then you're like, okay, but what's the other side? Well, you start to lend cheaper than you should. Maybe your collateral management isn't great, or you start making some loans that are unsecured, uncollateralized, and they want to write a big ticket, and so you start chasing some of that. I think you're going to see it.
What does it look like? If we're going to liken it to subprime,
I'm going to say
that's got to be some level of devastation.
Yeah, at our world level, yes, it would be. And presuming that the lender is somebody of some size. Where we are, maybe it's a blip in the curve, but as the marketplace kind of continues to grow, and I think competition heats up, and you start just buying customers with cheap rates.
Right.
I could 100% see the moving down the credit cycle a little bit, and you start lending to people at rates you probably shouldn't. I don't know why this wouldn't happen in crypto when it has happened in every other financial services market. On the other hand, for us, like, I think we have 75 to 100 borrowers, okay, right now. And so our average loan is, call it $3 million, $4 million, kind of somewhere in that area. I actually don't think our addressable universe for the super prime credit is that much bigger.
Sure.
I don't think this number is 1,000 counterparties that we could possibly lend to, given who we want to lend to and given the size of the space. Now, the space size is going to grow, and hopefully we continue to attract those guys. But chasing that 101st borrower, 102nd borrower, just to acquire customers, that's how you lose. So I care much more about risk-adjusted returns than the overall size of the portfolio or what the origination numbers might be. So I'm very, very kind of mindful of that.
The lending business model itself is quite simple. I mean, there's not that many levers to pull to compete against, I guess. The market's still in the early days of figuring out how to rationally price risk and counterparty risk. You mentioned risk-adjusted returns. Have those tightened recently? Like, what are you guys seeing on that front?
Yeah, I think there are counterparties that'll come to us and say, hey, so-and-so is offering me 2.5% uncollateralized Bitcoin loan. Right? Mm-hmm. Can you beat it? No. And we have to be comfortable saying
who are these
no.
people giving those terms out?
I don't know.
I don't know them.
Yeah.
But I would guess that some of them are exchanges.
Right.
Interesting.
To try to get more exchange trading volume, providing some credit to their customers. I could sort of see that scenario.
Gotcha.
Right?
Classic customer acquisition grab.
But like that's something we just can't chase. We can't make that work.
Yeah.
Even if I had a lender at 1%, which I don't, making an unsecured loan at 2.5% doesn't make any sense.
Yeah. Well, hey, I think doom and gloom, potential devastation is a great place to end.
I'm not guaranteeing that. That's not what I said. But
small
potentials as to a growing market and mispriced lending.
Got it.
Michael,
well, let's end on a positive note, actually.
Yeah, sure. Why not?
Market sentiment shifting.
Is someone going to bring out some booze?
Scotch.
Yes. What's the positive note?
Just shifts in market sentiment. How's that impacted the business? You gave us some of the numbers.
Yeah, I think, all it really takes is like 3 to 5% move to get people fired up again.
Right.
And I feel like once we start getting fired up, it's not going to stop at,
Yeah, I think that's right. And look, there are some people that's still calling this move from 3 to 5 a dead cat bounce.
Yeah.
Right? They'll still feel that way. But like,
what do we need to get to where we realize that we're over that hump, you think?
I still
6K?
Yeah, I think 60, 200, whatever the big support level was in 2018, we can kind of get through that. There might not be much until like 10. But like, people remain bullish. I don't know anybody who, even if they sold their Bitcoin, think that like are no longer bullish about the asset class regardless. And I feel much better infrastructure wise about where we are in 2019 than we were in 2017. So hopefully entrepreneurs are smarter, more companies are entering the space, and we're much more ready to kind of handle institutional demand the next time around.
And all the Floyd Mayweathers and Paris Hiltons.
Paragon.
Yeah, keep out. Michael, thank you so much for joining us. We really appreciate it. We'd like to take a minute to thank our sponsor, Cash App. Cash App has been the #1 in finance on the App Store for almost 2 years. It was the first major peer-to-peer payments app to support Bitcoin, and it's still the fastest and easiest way to on-ramp fiat. No more waiting 5 days for your ACH transfer to come through. With Cash App, you can buy Bitcoin instantly. When you're ready to take full ownership of your private keys, just use Cash App to scan an external wallet's QR code. It's really that simple. Cash App also comes with standard banking features like direct deposits and others your bank would never even consider, like Cash Card, a customizable debit card that lets you instantly save every time you use it at Lyft, Whole Foods, Chipotle, Chick-fil-A, Starbucks, Dunkin', local coffee shops, and a whole lot more. Download Cash App today from the App Store or Google Play.